Thanks for joining us today as we drill down on mineral valuations and conservation easement programs. My name is Russell Putnam. I've been a due diligence analyst with FactRight for 4 years, and I'm FactRight's primary analyst for conservation easement programs, oil and gas partnerships, and private placement investments. If you have any questions regarding today's presentation, I'd ask that you reach out to me directly following the presentation at russell@factright.com or 847-805-6120. Today, joining us is Dr. Andrew Schissler, adjunct professor at the Colorado School of Mines. I'm going to introduce Dr. Schissler in a bit, but first, why are we even here today? Over the last few years, FactRight has reviewed a number of investment programs in the broker-dealer channel that offer investors a mining or conservation easement option. Specifically, these investment programs purchase an undeveloped tract of land and then give investors the option to choose to mine the property, which could produce cash returns over a 20-plus year period, or alternatively, investors could choose to place a perpetual conservation easement on the property. Now, as many of us know, the conservation easement would limit the future use or development of the property, and it would provide investors with a charitable contribution federal income tax deduction that is based on the value of that easement. As part of these investment programs, product sponsors generally engage a consulting geologist to complete a mineral valuation report to support the viability of the mining plan. This mineral valuation report usually addresses the estimated reserves on the property, mineral pricing, production costs, market supply and demand, and other factors that the geologist uses to estimate the value of a potential mining operation on the property. The mineral valuation report is one of the most key documents in reviewing these types of investment programs, regardless of whether the investors choose the mining proposal or the conservation proposal. And the reason this document is so important is because the product sponsor relies on this report to project investor returns if investors do choose the mining option, or alternatively, oftentimes the qualified appraiser often relies on this study to estimate the fair market value of the easement. Because of the significant role that the mineral valuation report plays in these offerings, and FactRight's commitment to providing a detailed assessment of offering risks, we have engaged Dr. Andrew Schissler, adjunct professor at the Colorado School of Mines, to perform an independent assessment of sponsor-obtained mineral valuation reports for these types of investment programs. Today, we're going to cover how Dr. Schissler assesses the estimated value of these mineral rights, and we're going to cover some key due diligence considerations that you should consider when reviewing programs that have a mining strategy. But before we get into the details, I want to introduce our guest, Dr. Schissler. Dr. Schissler, I'm sure our audience is really curious. How did you become involved in the mining industry, and in what capacities have you worked for?
Thank you, Russell. I entered Colorado School of Mines as a freshman in 1975. I chose that school because I thought it was the best technical school in Colorado, and in fact, the mining engineering department to this day is rated the top mining engineering department worldwide. I chose mining engineering because it was an engineering discipline that combined all facets of engineering into one practice. And I have, over my experience, I've worked 45 years in the mining industry in capacities ranging from laborer to executive vice president of engineering for a company, holding all positions in between. With regard to valuation of mineral reports, I've done over 65 mineral valuation reports in all mineral lines in worldwide geographical locations. I hold a credential called a registered founding member of the Society for Mining, Metallurgy, and Exploration. It's an earned credential that allows me to be a qualified person, a QP, and most security and exchanges of countries in the world require mineral valuation reports that reach the public domain to be independently authored by a QP. So I have that credential. I'm very happy to be of service for FactRight and its clients.
Well, we're definitely happy to have you. There's no question about that. Thanks a lot for that introduction. Certainly, you have a wealth of experience that is going to bolster the due diligence that FactRight completes on mining strategy programs. And we really believe that your experience and assessment is going to help broker-dealers make better informed decisions when reviewing alternative investments. Clearly, you have experience in the mining industry that most of us in the broker-dealer space, we just don't have. So for those of us that aren't as familiar with mining or quarry operations, I was hoping you could provide us a little background. Specifically, a lot of the programs that we review involve the mining and sale of limestone, granite, or waste rock aggregate. Generally speaking, what are these minerals used for in the marketplace?
The granite and limestone quarrying and rock excavation join the general category of industrial minerals extraction and production. Those minerals are used in crushed rock form for road building and construction, and in surgically extracted rock from a quarry. The rock products are used in residential granite countertops and also for memorial stone for memorial stones and headstones. Some of the recent projects that FactRight has given me the opportunity to review involve granite in Georgia. And Georgian granite is a very high quality and it's very versatile to be used in both crushed form for construction and then dimension stone, which refers to headstones and tabletop, granite tabletop, so forth.
Dr. Schissler, you mentioned what you've been working with FactRight so far. And in working with FactRight, what we're asking you to do is determine whether the assumptions and the projections in these mineral valuation reports are reasonable. And some of the assumptions that we have you specifically focus on include reserves, production, timeline and permitting, mineral pricing, production and equipment costs, market supply and demand, and finally, operator availability. But I really want to start with reserves. When we look at mineral valuation reports, the consulting geologist will often engage an engineer to drill the property and test the minerals, and then estimate the value of the reserves. How do you determine whether the reserve estimate process completed by that engineer is reasonable and in line with industry standards?
Industry standards require minerals and their presence in the ground be defined with regard to confidence levels. And typically resources and reserves are qualified and quantified in 3 levels of confidence, depending on the existence of mineral away from what's called ground truth. The best method of extracting ground truth is to drill a mineral deposit and extract rock core from the holes. Also, when mineral deposits are sufficiently shallow and close to the surface, they can be trench sampled and actual rock obtained from trenching to obtain what we call ground truth. And once ground truth is appropriated, mainly from drilling, then the rock core is analyzed for quantity and quality. And the most important criteria of collecting and assessing reserves and resource quantity and quality is the spacing of the drill holes. For example, if one was drilling a potential gold deposit, drill holes might be required on 50-foot centers. If one was drilling and proving the valuation for a coal deposit, drill holes might be satisfactory on quarter-mile centers. The purpose of sampling and obtaining ground truth from the drill holes is to define the most important factor in geology, and that's the variability of geology. because rock does vary. It's something you can't see, it's in the ground. And the only thing that we do, that we have at our disposal, is to drill it.
I think pretty clearly the reserves on a property is really the starting point for any sort of evaluation like this. And once you've seen that reserve estimate, the mineral evaluation report will also estimate the amount of minerals that actually can be produced from the property. What is your thought process when evaluating whether the geologist's estimate of what the company could actually extract is actually reasonable?
Once the minerals are defined in place, the minerals are computed as to the quantity of in-place mineral, usually with respect to the tons or weight of the mineral. But then the intended mining process and extraction process incurs a recovery. So there's losses through the extraction process. So that factor of percent recovery has to be applied to in-place minerals, and various mining methods and geologic physical criteria come to bear on the percent recovery that converts the numerical value of in-place reserves to recoverable reserves and actual tons that translate to saleable tons. And that is from various, the percent recovery factor is derived from various, it begins with the actual intended mining method, and then several other factors are applied.
Generally, these projected timelines for these quarries in these programs can be quite long, often 25 years or more. What factors do you consider when assessing the project timeline for a quarry? Not only in terms of how the operator could, how long they could operate the mine, but also how long will it take to get permitting and get the quarry up and running?
That's a very good question, Russell. All mines and extraction processes obey what we call a mining continuum. It starts with prospecting, which is to find the mineral. The next step is exploration, which is to prove the presence of the mineral through drilling. The next step is feasibility, taking the results of the drilling program and compiling mineral evaluation reports for the purpose intended. In the circumstance being talked about today, it's for valuing a mineral for a conservation easement program, but it could be very well for performing feasibility for developing the mine. Once the feasibility, and it's an economic feasibility and also a feasibility of the presence of the ore, the mineral, and also all feasibility must contain a very robust risk valuation as part of the mineral evaluation report. The next step is mine development. That's to build a mine if feasibility proves satisfactory. And then the next stage is the operations stage. And then finally, mine closure once the reserves are extracted, the economic reserves are extracted. The permitting stage precedes mine development before you can move dirt. And mine permitting can take from 1 to 3 years. Sometimes it can be abbreviated shorter than 1 year. It all revolves around whether the impact that the mine will have to the environment can utilize and leverage existing baseline information that might be available. If baseline ecological and environmental information is not available, then you have to go out and get that data by sampling through at least 4 seasons, 1 year of data of biota, wildlife, water quality, socioeconomic impact assessment, the entire gamut. Sometimes though, with a mine, a potential mine, a future mine, a quarry being located in a mature mine district, permitting the baseline information is available. The impact can be leveraged through that other information and a permit appropriated in 1 year or less.
Well, I appreciate that. I know starting to work on more and more of these programs, the permitting process for someone who's not really familiar with the mining process can be pretty complicated. So I really appreciate the value you're going to bring to the factor reports on that type of factor and assessment. And we're kind of moving forward through the process. We're extracting minerals from the ground, we're producing them, we're looking through the timeline. But one of the biggest factors that drive the value of these operations is the actual price that the operator would be able to market the minerals that are taken from the ground. What is your process to evaluate whether the pricing assumptions are in line with similar pricing for other projects in the area?
The minerals basically are commodities, and it's more difficult to add value from the perspective of a mine to an ounce of gold or a ton of coal or a pound of copper or a raw piece of dimension stone for use that would be sent to a finisher that would actually polish the stone. So mines deal in commodities, so we have to be price takers rather than price makers in the marketplace. What I do in reviewing a mineral evaluation report is to assess, one, has a study been done comparing supply and demand of the mineral as it might be sold into the marketplace. The area of supply of which the demand, which a mine can supply minerals to, sometimes is worldwide, and sometimes it's a very local geographical area. It has to do with if the type of commodity it is, the degree at which weight of the product plays in freight costs and the overall cost of production, and some other factors. Once I go through that review using those steps, then I would assess and make a judgment if the price projection for the mineral that's found in the valuation report is realistic and reasonable. I should mention that one accepted standard in mineral evaluation, in the mineral evaluation reporting industry, is in the absence of other rationale, using a historical 3-year average for price is a defendable number for most security and exchange commissions for public domain reports.
Now, along with that pricing that you were just touching on, projected costs for these programs are also very key. These costs could include site preparation, office expenses, labor, insurance, and taxes and equipment. How do you determine whether the estimated costs are reasonable?
The combination of 3 methods. One, I will look at evaluation report and do some zero-based budgeting and recreate costs of production to see if my independent analysis is reasonable as compared to the others. For example, a zero-based analysis would be taking a mine plan and estimating the total hours of truck haulage per year, and then multiplying that by fuel used per hour, gallons per hour, and then a cost of dollars per gallon. And that calculation chain would yield the cost of fuel per year for the mine, and then that divided by the tons is a cost per ton. And the second method I would use is the indexing method, just as with, say, estimating the cost of building a building. There are several databases available to the mining engineer that other mining engineers have published indices and potential costs of various size information. I have those at my disposal to compare the cost, the estimated production cost in the mineral evaluation report. And then finally, I'll use known historical costs of production. Sometimes that's the most accurate way of checking a cost, especially in assessing the level of capital cost projection for a mine. Capital being defined as any expenditure having for an asset having a life of greater than a year. So say if you're estimating the cost of building a building for a quarry or a mine, if one can find what the last one cost that actually was built, then that's the most accurate form of projecting the cost of something in the future.
So now we have a feel for whether there are reserves on the property, whether they can be extracted, and price and cost for selling those minerals. But how do we actually know whether there's even any market demand for that quarry as contemplated?
The best method, since mines have to be price takers rather than price makers, the best market entry assessment is to assess the cost of production and place that potential mine on a supply cost curve to see where the potential additional production falls in a like mineral composite and quarry composite graph of a supply cost curve. The best guarantee of new production of a commodity going into the marketplace rests on where the new production falls on the cost of production against other competitors, knowing that, again, mines have to be price takers rather than price makers.
Thanks for that. I really appreciate the insight. Now, generally, the product sponsors, there's been a lot more of these types of programs in the market over the last few years, and the products that Factrite has seen, the product sponsors generally don't have a lot of meaningful mining experience to actually run the quarry as contemplated in the mining plan. And what that means is that they would need to be relying on third parties to actually operate the mine. What do you look at to determine whether there's mining personnel that's readily available in the area to actually run the quarry?
The most important factor I review is the local mining and quarrying industry has reached a state of maturity. If a mine is the first mine of its type, of its commodity in a wide geographical area, then the mine in going in will have to draw upon a new workforce and import the workforce into its geographical location. If a mine is in a mature mining industry, that has always proven that it provides a very readily available supply of experienced miners and salaried personnel. There's one caveat to this rationale I just said, and we found out in the mining industry that some of the most productive mines in the world are ones that have started from scratch, hired a core group of experienced personnel, very small group, and then hired local people from the area and trained them to work safe and productively. And again, those I can cite some examples of the most productive and safest and most profitable operations in the world. In the projects that Factrite has given me to review so far, the mines have been in mature mining industries, geographical areas where there'll be readily available personnel.
This has been a really great discussion. Clearly, there are a lot of factors that you think about when assessing whether these projected mining plans are reasonable. Dr. Schissler, do you have any final thoughts that you'd like to share with our listeners today about what you're really focusing on when determining whether these mining plans are actually viable options?
Throughout the review of the mineral evaluation report, I'll put to it a reasonable test concept At the end of the mineral evaluation, I will provide a SWOT analysis, strength, weaknesses, opportunities, threats analysis independently. I always like to do that no matter what I'm doing on a mining project. And the final thing I do is the controlling document, and the most important document in the mineral evaluation report is the end result, which is the pro forma business plan expressed in a spreadsheet basis. And mineral evaluation reports usually take on the form of a discounted cash flow rate of return spreadsheet that performs risk analysis in terms of a spider diagram, adding and decreasing costs and revenue and pricing and expenditures by plus or minus 10 or 15% to see its effect on the bottom line. What I do, since that spreadsheet is the most important document, is I look for, I go down line by line and try to convince myself if each number has a basis or not. And if in looking at assessing those line by line numbers, if there is, I'm looking for sufficient basis for that number, its magnitude being in the spreadsheet.
It's interesting that you touched on the pro forma. I think most of us that are on the call and are listening in understand the importance of that pro forma for the mining plan projections, and also how it is used to value the conservation easement. So I think it's really important that you touched on that. And what I really want to say is we really appreciate your time, Dr. Schissler, sharing your time and your thoughts with us today. We at FactRight here really believe that your work with us is going to provide broker dealers with more transparency and a better understanding of mining programs. And we think that your assessment is going to allow broker dealers in our industry to make better informed decisions. Before we do sign off, I do want to direct everyone to the contact information at the bottom of the webinar slide one last time. If you do have any specific questions regarding today's presentation or Dr. Schissler's role with FactRight, or any specific programs you're seeing, or any other topics that come up in terms of mining projects or conservation easement programs that you see, please do reach out to me. I would love to talk with you. My email is russell@factright.com, or you can give me a call at 847-805-6120. In summary, we think these programs are really interesting strategies to work on, and we think that Dr. Schissler's assessment is going to provide an independent assessment that you're not getting from a lot of other places. So if you do have any other questions about these types of programs, please reach out to me, and I definitely look forward to speaking with you as you consider alternative investments in the future. Thank you, and have a great afternoon.
Thank you.